In this video, I'll be going through the importance of daily forecasting. A realization that I've had over the course of the last few months is that when you have a monthly target, you really need to decompose that monthly target into its days if you want to turn forecasting into an exercise of execution as opposed to an exercise in modeling. And so when you go and say that we want to do X amount of revenue in November at X MER or X ROAS, whatever it might be, looking at that blended figure and then simply working through the month hoping to achieve it, it's very hard to work against execution to be able to hit a number like that. But the second you decompose the number into individual daily targets that need to be hit, you can start to control the actions, the inputs, and the execution that's required to then sum all of the days together that then step up to the monthly target that you've laid out. And so in this video, I'll be going into a little bit more detail about how exactly you should be approaching this. I'll go through an example that we have right here of a client December 2024 pacing. And I'll give this sheet away to you if you're an e-commerce brand. If you go to our website, fill in the form, reach out to us, and simply ask for the daily forecasting sheet, and we'll provide this to you. Now, this is a very rudimentary sheet, and this is not what we use on the back end. We actually have some regression modeling that automates this entire process. But what we have here is daily total revenue. We have daily spend across Google and Meta. We then sum that spend up. We have an MER calculation, which we've actually adjusted slightly. And then we have profit contribution as well. For this particular account, you'll see that the target for December is 300,000 USD at a 3 MER. And so that ends up meaning that we need to spend $100,000 through the month. This particular exercise in daily forecasting is really made the most prevalent when you're looking at a month like December. And that's why this video is using December in particular. Because in February, in March, you might have relatively consistent spend across the month. You might not have any moments or events that are occurring that might cause a spike in ad spend and a spike in efficiency. And therefore, daily forecasting is going to give you an idea of whether you're on track or not, but it's not going to give you any idea of how you need to be dynamically changing strategies throughout the month. Comparatively, in December, you can see that we enter December, and this is one of the first Black Fridays that this has occurred, at least since I've been doing Black Fridays in the last 5 years, where Cyber Monday ends in December. And so we're actually starting the month with a spike that's going to occur on Cyber Monday. This happens every single year. You can look at pacing historically, and I highly recommend doing that. And so use this sheet, but rather than putting in future data, put in historical data. Have 2023 December pacing, 2022 December pacing, 2021. Graph it using the graph on the right and look at the trends. What you'll notice is that acquisition MER or MER, depending on how you're cutting the figures, will always spike on Black Friday, and then there'll be a secondary spike on Cyber Monday that isn't as aggressive. And so what this ends up meaning is that these are moments that you can seriously capitalize on by pushing up spend. And in this case, we're confident in going from 3.3 on the Sunday up to 7.2 as we round that sale period out. From there, there's an immediate reduction that we've planned in because we assume that efficiency on acquisition is going to decrease substantially. And then from there, there's going to be a slow but steady rise over the course of the next 1.5 weeks to the 18th. Now, why is this occurring? Why are we modeling this in? Because on the 18th, that's the shipping cutoff date. And that's going to be visible on the website. It's also going to be very visible in top of funnel assets as well. And so we're going to slowly see conversion rates creep up every single day that we move forward from the 3rd. And as conversion rates move up, it allows us to operate at higher ad spends while still maintaining profitability on acquisition. Because ultimately, that is how you should be looking at these moments in which you're spiking spend. Why on the 2nd are we able to increase budgets? It's because conversion rates increase across the board. And so we can drive incrementally more traffic that's going to cost more and generally convert worse. But we can guarantee that on this day, that incremental traffic that typically converts at a level that's not going to be profitable, it's actually going to flip and become incrementally profitable because the mean or the median or whatever measure of average we're using, conversion rate has shifted up, which should shift this top threshold up as well. And this is what's happening as we start to move through the month, is that conversion rates are increasing steadily. And we see this in historical figures. Once again, don't just take theory and apply it into your figures and your projections. Just look at historical data. So look at last December and see, did conversion rates steadily increase across this time period? And if they did, it meant that you could better have capitalized on scaling up paid media whilst maintaining conversion rates rather than letting them slide up. and then generating more total profit contribution within the business. And so that is exactly what we're doing here. We are forecasting the conversion rates are going to have a steady improvement, and we're then building that into the model. Right on the 19th is going to be a substantial decline. Now, there's actually a slow trickle off from the 19th onwards, and that's because they're the figures that we've seen historically for this brand in 2023 and 2022. Now, there's other brands that have a very steep drop off where all of a sudden they're significantly down by about 80 to 90%. Not for this brand, and so we've modeled that in. Then from the 20th to the 25th, you'll see that profit contribution actually goes negative, and that's because we have operating expenses layered into this specific example. For accuracy, I've gone and removed the operating expenses so we can just strictly look at MER and profit contribution. And what you'll notice is that MER is remaining stable over this entire time period, and that's because we are trying to control for MER based on spend fluctuations. And so all of these spend predictions here are based on what we believe we can spend whilst maintaining that efficiency. And that is what's determining the key variable that's changing on a day-to-day basis, which is our total spend, which is really just a derivative of meta spend. From here, this is one of the worst weeks in trading in e-commerce, particularly in this period of the year. We then go into the 26th, which is a Boxing Day sale. Now, this is a US-based brand, and so this is actually not as applicable because the US doesn't do Boxing Day sales. This is a very big Australian event. And for context for anyone watching this outside of Australia, Boxing Day is the second largest trading day in retail in Australia. And so this is enormous, and we generally see an enormous spike here. This won't be as much for this brand. However, they did something similar last year, managed to generate quite a large increase in demand through doing a post-Christmas sale or a stock sale, stock clearance sale. And so we believe we should be able to maintain its effectiveness this year and spend about $2,000 whilst maintaining efficiency. And then that's dropping off again to some of the lowest periods of the month. And so it's only through this steady forecasting and decomposing the month into its individual days that we can start to identify how we can layer up to the overall target. The issue with not decomposing to a daily level here is that you can get to day 7 and we could be on a run rate that is for 300,000 by simply doing, and I know every single e-commerce owner has always done this, is that they go, well, so far we've done $50,000 this month. We'll just divide that by 7, and then we'll just times that by how many days are in the month. And that's going to tell us, if we continue with this run rate, what we should hit. And they do the run rate calculation. And let's actually make this equal 300,000. So they do the run rate and they go, oh, okay, we're on track for 310. Nice, we're going to hit our target. But obviously what they haven't factored in is that, yes, we're going to run at this for another 7 days. And then there's going to be 2 weeks essentially in December that are 90% down in terms of regular revenue run rate. Unless we plan to create moments here, unless we plan to put some kind of marketing event in here, unless we plan to have some kind of EDM returning customer offer that's going to generate extra revenue, not from acquisition, but from retention. Unless there's some kind of planning that's going to prevent this dip, which is something that we always do. If we know that there's a dip in the calendar year for a client, we will plan accordingly to prevent those dips. But if we see that there's nothing that we can really do here, and I'm going to give a sneak peek into our thoughts on this, and that's that there really isn't too much you can do at this specific moment in the year. The general fact is that people aren't in high consumer demand in this period, but there are some things, depending on your brand and depending on your niche, you can make this work and not bounce as low as it might need to. But regardless, if you weren't planning for this accordingly, you would simply get to here and then completely fall short of targets. And so you need to understand how the revenue is going to distribute across the month to be able to know how you're going to layer up to a specific target and then track against it. And so on a day-to-day basis, have the revenue, have the spend measured, have the profit contribution measured, and then understand, are we pacing on target for what we predicted and modeled, or are we pacing below target? And if we're pacing above, then maybe we can be a little bit less aggressive here and not need to go as hard, particularly if we're under MER. If we're under pacing, we know that we need to make it up somehow. And we're not just going to continue running the same strategy and make it up. We need to change inputs. We need to maybe run the offer slightly more aggressively. Maybe we need to do more on the retention front. Maybe we need to put 50 to 100 new assets into the Facebook ad account to increase the probability of hitting efficiency targets. There are inputs that then need to be generated if we are underpacing on the live tracker. And the only way to do that is to pace against expected outcomes on a daily basis. And then obviously you can wrap this all, and we have a advanced version of this sheet that pulls into all of our different master input sheets, which shows us how we're pacing on a day-to-day. And so we can see exactly how we're pacing in dollar figures, in percentages, graph it out, and then change our inputs and change what we need to do to be able to generate a desired outcome for the month. And so the conclusion of this video is that if you're not forecasting daily revenue and efficiency at just a bare minimum on every single month, and ideally you would do this a few months in advance, and then tracking against those KPIs and inputting action items if you are not on track, then you really need to be reassessing your approach to monthly and daily forecasting, projections, targets that you're putting down, particularly if you're working with an agency. If you're saying, hey, go hit this number, and then it's not being decomposed into any way as to what's going to step up to that figure through those daily numbers, then you're going to find it very difficult at the end of the month to be able to determine, well, we got to the end of the month, we didn't hit our target, why? And retrospectively, what could have we done? What were the leading indicators that said that we weren't going to hit it? And then what kind of inputs can we start to put into the account, put into the strategy that's going to make up for the lag in the first few days, the first few weeks of a particular month?